Good evening, all. Ira Epstein, and here we are with your Tuesday evening metal market update. And this update is for the evening of January 9th, 2024, and the time's 5:50 p.m. Central Time. Now, I've prepared the ad for the next live webinar. It'll be a week from today, January 16th. So I hope to see you there. It'll be 12:30 p.m. If I have your email address, you'll be the first ones to get something tomorrow from me. Sign up. The seating fills like that. Now, today was tip-off day, and it isn't football that I'm talking about. In Bitcoin, believe it or not, the SEC X account, the old Twitter account, was hacked. And on it, it came out that the SEC approved ETF on Bitcoin. Of course, they didn't. It was a hack. But you're not getting that big jump in the market you thought. I always look for ideas. You got up to about 48,000. The SEC quickly came back. But you know, when you hack one of these accounts, nobody's looking at it second by second to know, oh, it was hacked at 1 o'clock in the afternoon. Now it's 1:01 and we're taking that off. That would be the unusual thing that happens. So the market saw it, traders saw it, they jumped on it. I'm not saying that that's all the market would go up by any stretch of the imagination, but 48,000 was disappointing. I have been saying that maybe the market can get to 50,000 on the pop. I'm wondering if I was being too generous in that. Don't know, but it's something to think about. So we're looking tonight at another attack by the Houthis in the Red Sea. It just happened, so this is breaking news. It was rather sophisticated. It was thrown back. But how can you, if you're a cargo company, an oil tanker company, you can't possibly be sending your ships through there. I mean, you could do whatever you want. You're going to be self-insuring because every insurance company worth their salt is just going to keep raising the rates on it. And it puts the coalition in a difficult spot. Gold is up on the news ever so slightly, up 370. Silver getting a little bit of a bid. Copper market sort of drifting right here along with the platinum market, not doing much. The dollar's had a good little rally. It's come back. It's not dramatic. This is not a market up anywhere near 104. But what the markets are waiting for is on the Thursday numbers. That's where the key is. On Thursday, we get CPI. On Friday, the PPI numbers. So between those two, that's going to give us a pretty good idea of what the market thinks. You still have traders fighting what I think is going to happen. Still a majority of traders, not a whopping majority, but a majority think that there's still a March cut in the works. I don't see that at all. I just wrote a report tonight as to what 3 of the main big banks are writing, and I can tell you nobody's looking for a March cut. Some are out to the first cut being in September. Some are no more than 2-3 cuts for the year. So you've got different ideas, but again, it's all going to be data-driven. It would take a monster break of CPI and PPI for this market to crash. And the reason I don't think that's going to happen in those numbers, are you looking at what's happened in retail sales over November and December so far? Earnings season's beginning, and you're starting to hear from the retailers, and it's strong. If you looked at yesterday's credit numbers, you saw that the credit cards, whoa, instead of a 9 billion number, they got a 23 billion. People are buying things. That doesn't take down CPI. So that's all I can say about it. When you take a look at the gold market, you're backing off for the period so far. This is a weekly chart, and for the week, you're down $13, about 0.75 of a percentage point in that area. You're back into an area of 2036. You know, I've been saying the 2050 area is probably a zone where the market's going to fight a battle, and you're $14 under that at this point. The trend is down. You do have lower highs, lower lows. What else? The battleground, the reason I came with the 2050 area, is the 18-day average of closes. The line in the sand, as I love to call it, is 2054.40. That is where the battle is. That determines the bias of the market. When the market is under that number, I have an automatic bearish bias. Since the trend is already down into swing line with lower highs, lower lows, I am very much in the bear camp in the market. And one of the first spots to look for could be the 200-day average at 2013.60. But you look at the Bollinger Band with it, and that's just above it now at 2019.30, but it's a good zone. So if the market decides to fall, that would be it. I don't think that up $3 off this Houthi attack is saying that the market's going to go bonkers because there's another attack in the Red Sea. Rather, as I have said all the way through, nothing is stopping these Houthis. It's going to take an attack on them, and nobody wants to do that. We are in the game where the coalition doesn't want the Mideast war to spread, so they play the defensive game. Is it the right game to play? Well, if you're a hawk like me, it is certainly not the right game to play, because that's all you're going to be doing is playing it until they get lucky and either kill somebody on these ships or sink a ship. On the other hand, you don't want the bigger war, so everybody's walking the fine line, especially given that Israel has now a delegation in Cairo, and they're again talking a prisoner exchange possibility and a cessation of the war event for some period of time that they can come to an agreement with. So does it help that the Houthis are doing this? It doesn't. They're not helping their own cause, but they don't care. Their game is one thing, terrorism. So as you look at where the market's at, you can see that the market could be coming down there. The resistance point pretty laid out, and the market's oversold. Oversold conditions don't beget new short positions from my point of view. This means that breaks down there are definitely short covering areas, not new short areas. The gold-silver ratio continues to stay with the market well over the red line. The 18-day average of closes gives gold the bullish bias. And you can see in the silver, it's under all these averages. Look, it's under the 200, the 18, the green is the 100 through there. Under all three of those, next stopping spot, if it continues to leak away, 2282.5. The lower band, it's already oversold. So I don't think you're going to get a lot of traders, at least the good pro-algo traders, as I like to call them. They'll build that in and they go, maybe we don't add positions when a market's overbought or oversold. In the copper market, as far as I'm concerned, if you were next to me, you get a jab in your side and I go, you're short. You're down to the Bollinger Band, the 100-day average, and you've got an oversold condition. Tell me again what you're looking for and how far down. You only stay under that black line 95% of the time. You're out of it, 5% under it, and you want to play it's going to keep going. Okay. In the platinum market, about the same thing. Oversold market, trend down, fighting a battle at the 200-day average and the 18. How fast this market went from staying over that 200-day average to coming back and that number becoming a big resistance point. If the market wants to go and get, hey, let's go get the last of the diehard longs and squeeze them out, you could get down to the 100-day average to 936, the lower Bollinger Band. You don't have to, but that could be where it goes. In the dollar index, you just seem to be going one day up, one day down. It's got bullish bias, no trend, a lot of resistance. You're going to see this 18-day, the 200-day average. I didn't mean to say 18, 200-day, and the Bollinger Band are going to come together. Now, the market isn't open yet. It'll open just a little while here. That Bollinger Band's going to fall very close to that 200-day average. That's your big resistance spot now. I would not be targeting any longer. I know that a lot of people are thinking 104. I think you have problems right there. I think it's going to all come together at that number. Now, one of the patterns you're getting regularly, and it's happening over and over right now, are outside days on your charts. I'm seeing I'll bet you if I cover 10 charts, one of them has it right now. So when I'm looking at 40 charts in the subscriber videos, I'm seeing 3 to 5 of them. I can tell you that right now. And it's an edge in the market. When you see that pattern, if it's going in the direction the market had been going, it's a continuation pattern. But if you have a market that's been soaring to the upside and suddenly you get an outside day to the downside, what do you do with it? How do you measure what it's going to do? Well, I put this all together in my course. And in my course, you also get 14-day trial to my futures, this morning subscriber video especially, where you get to see me review it with you right then and there. We give you the charting software so that your charting software will do exactly what mine does with all this. And because this is such a common pattern, it's something you have to really get attuned to. It's very, very important. It's probably one of the most common patterns on a chart, and I'm amazed at how many people have no idea what to do with it. Go to iraepstein.com under the word education. It's there. Go take a look at it. You can also go do this by follow my finger right up here and give it a click right through there, and that should do the job for you. So those are the ways I look at it. I'm Ira Epstein. Hope you take advantage of it. I will see you all in my next video. You have a good evening.